Yesterday, we discussed how what we saw were some signs of what we expect to play out in 2022, but that we didn't expect it all to occur in one day, and that the entire day wasn't necessarily reflective of what 22 is actually going to look like. Today, another day of 2022, the second day, and we're starting to see a little bit more realism to how our 2022 projections are expected to go. And of course, later in the year, we'll know with hindsight whether we're right. But we're very heavily weighted in energy, and we have another fantastic day for energy again, up about 6.5% year to date so far. It's only two days so far. Yesterday, we saw energy up 3%, today up 3.5%. That is a fantastic start. I definitely don't expect the pace to continue. I'm very happy it is going this way. But we kind of had several things occur for us in a beneficial way to start the year. One was a seeming capitulation of Omicron. So a lot of this move is not really, we're not there yet, okay? This is really just a catch-up move. We had some pain towards the end of 2021. Yes, we're now seeing something great at the start of 2022. And yes, it's a great sign that it is the first and second day of 2022 that we do see this kind of move, but still not super there yet. I think we're getting there. I don't doubt my talk here. I think we're getting there. But I think the move we're seeing is not an indication of forward progress. I think it's really just a recouping of unnecessary backwards progress. And you can go back into the videos since the day after Thanksgiving, when we first started to see this Omicron thing. We went out there pretty quick with the initial data that we got, and we extrapolated that and projected that out and expected Omicron to be less deadly, and it was. And we expected, as soon as we knew it was spreading faster, for that to be bullish. And that seems to be the sentiment permeating throughout the market, and that for good reason. We believed in that sentiment. And we think over here we're going to continue, hopefully, to be ahead of the coronavirus curve, as we were before the pandemic even started. Let's not forget, quick plug, that is how this channel came into existence. That was our first video ever, was discussing the potential for a coronavirus downturn, and market not considering that, on January 27th of 2020. So we're now seeing the fears lift. We're now seeing things work out in favor of Corona, which is good. We're still in catch-up mode of previous losses. And these losses go back until June, actually, of 2021. Just coronavirus specific with regards to energy, go back to June 2021. We then started to see signs of a Delta wave that impacted the price of oil and impacted energy stocks. And that seemed to not be material, because shortly after that wave hit a top, we had a massive run in both energy stocks and oil prices, up to multi-year highs, and oil prices 7-year highs to about $85 a barrel. And that peaked as Delta resurged again in Germany and Austria and capitulated with Omicron. Now we're seeing calming of the nerves and catching up, recuperating those losses, which I expect everyone around me mostly to expect, will lead to, yet again, new 52-week highs in both energy stocks and the price of oil, and new multi-year highs in the price of oil. The supply deficit remains, and it wasn't supposed to remain at this point over the summer in August when we hit $85 a barrel. But OPEC has recently revised that they expect the supply deficit to remain in first and second quarter of this year. I expect it to be longer than that. I think that is a reasonable time frame that you can project. There's obviously a lot of unknown in the future. It's very reasonable and easy to project Q1 and Q2. When we're looking at Q3 and beyond, well, people got to start talking about new drilling projects. They got to start that. They got to plan that. They got to purchase that land. Exxon did one deal in Brazil, which seems like it's going to take a while. Nobody else, I haven't really heard a whole lot. I've seen asset sales, existing land being sold. So as far as I'm concerned, that Q1, Q2 deficit can extend beyond. So for the next 2 quarters, because we're in a deficit and we're seeing demand increase as global economies reopen and recover, the price of oil should essentially just steadily go up to compensate for that deficit until it reaches a point of maximalization. But we had $140 oil in 2014. That didn't seem to really cause any problems. Maybe that was a point of max, but we adjust for inflation. You know, even if we just give oil a $20 adjustment, which I think is relatively conservative, we're looking at another double, 100% gain in the price of oil. We'll see. We'll see what happens. I'm just sharing you some analysis I'm doing, and I think we can get to that range. I think if we got to that range, yes, we might start to see some pain, and we're not really going to know for certain until we get there. We'll likely see it in the data, in the purchasing of oil. So we're going to have to just see what happens. We're just going to see what happens, but I think there's plenty of runway left, and not really realizing gains in anything unless the option is unless it's an option and it's expiring soon, and then maybe you can sell today and hedge the risk, the opportunity risk, etc. You know, whatever. But we like oil. We're also seeing another thing occur today, which we think will take place in 2022, but didn't take place yesterday, but it's taking place today, and that's MegaCap tech pulling back. We like the products. We know they're good. We use them. But the companies are expensive, and they have benefited from this flight to safety notion. Typically, when people wanted to fly to safety, they went to treasury bonds. But treasury bonds are no longer offering that kind of safety because they're a guaranteed loss given where interest rates are and where the rate of inflation is. So real inflation. MegaCap Tech has benefited because they are a substitute good in the market for flights to safety. However, as rates peak up and push up, and as inflation likely doesn't continue at the same rate because they're not printing a whole lot of money, the Fed is tapering, there's not more stimulus, etc., and rates go up, well, treasury bonds finally start to look credible again. And they should be credible because we shouldn't have 4, 5, 6% inflation and 1.5% treasury. So now we're about to be 1.7, it looks like. Maybe we get to 1.92 and inflation comes back down to 3. Who knows? We'll see. Lots of unknowns, but it's a lot more different than where we were a couple weeks ago at 1.35 and 6% inflation, right? So, yeah, MegaCap Tech, we're not saying it's going to collapse, but the incremental buyer, the flight to safety buyer, is going to decompress. It's going to decrease. So they got to grow a whole lot. Not a whole lot. They got to grow in order to grow the share price. And they likely will. But they got a lot of forces, some forces against them that were forces for them that are not necessarily related to the product, the sales, the earnings, etc., except for the flight to safety aspect of all that. And it's just not a Goldilocks environment for MegaCap Tech anymore. In my opinion, we'll see. Remains to be seen. Hindsight is 2020. Do your own homework. This is my homework. These are my results. I'm turning them into you, the listener, the fan, and the possible customer. So that's today's video. Hope this provided you some value. We still like our 10x growth. Editas has hinted at an interesting announcement tomorrow, so we'll see what happens. Hopefully that stock does well. It seems like it's crushed and quite a good entry point, in my opinion. So we'll see what happens. We still like our 10x growth. We still like our energy. That's how we're playing 2022. In addition to mining materials companies and some reopening like Penn National Gaming. That's my portfolio for me and my clients. As always, any stock mentioned may be owned. So until next time, peace out.